Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee free transactions. Whether it's gaming, AI, or next gen dApps, Scale is here to power your future. Explore more at scale.space/ecosystem and follow them on X at Scale Network. This episode is sponsored by Ledger. This Black Friday, Ledger is offering an incredible deal to secure your digital assets. From November 29th to December 5th, upgrade to Ledger Flex and get $70 in Bitcoin. Plus, save up to 40% on select Ledger Nano wallets and accessories. These deals are only available while supplies last, so don't wait. Visit Ledger's website at ledger.com today to take advantage of the best offers of the year and protect your assets with the global leader in digital asset security. Meet Kraken Institutional. Whether you're an asset allocator, a trading firm, or high net worth individual, Kraken Institutional unlocks the powerful tools you and your organization need to trade and manage crypto at scale. Reliable, easy to integrate, with white glove service and 24/7 support. Visit kraken.com/institutions and get in touch today. This is not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payword Interactive Inc. View legal disclosures at kraken.com/legal/disclosures. Welcome back to another episode of Forward Guidance. And joining me today is Michael Cow. Michael, great to have you on the show. Been a big fan of your work, your writings, your musings. You always have some very interesting takes. So it's been long overdue to get you on the show. It's really great to have you on here.
Yeah, thanks for finally having me. Yeah, I apologize about the scheduling snafu a couple of weeks ago. So glad we could do this.
That's all good. Well, luckily there's a ton to talk about. So, we will have no shortage of that. I want to roll out the red carpet for you a little bit because, back in like late August, if we rewind back then and we just think about what was the sentiment at the time of the current macro landscape is there was a lot of concern about growth. There's a lot of concern that we are trickling our way into potential, even like a recession. And this was around the time when the Fed actually came out and cut 50 basis points. But you had you published an article that basically you mentioned that Powell was going to make a mistake by going 50 bips, that there was no concern for a recession, and you called him pusillanimous Powell. Basically, as a nicer way to put it than some other ways that you could have said it. But essentially, this was August 31st. Like at that time, the sentiment was very different than it is today. And you mentioned that basically it was going to be a policy mistake when we look back at it. So I just want to give you props for that, but then also unpack like what was driving that analysis, and then how has it panned out a few months later since?
Yeah, I guess. Apropos to your tweet earlier about pronouncing pusillanimous, I guess we could make today's session all about alliteration because I have a whole cast of characters. It's not just pusillanimous Powell. We now have bold Bowman and yellow-bellied Yellen as well to join the crowd. So I think when I wrote that piece, I highlighted a number of different factors. One was that I think, well, first of all, it was very unusual I made the case back then that he should not, when most people were calling for, oh my gosh, the Fed is too late to cut, I said, he's going to be way too early to cut. And just everything I'm looking at, not just, stock market metrics, but just measures of core inflation, measures of liquidity. It just didn't seem to justify a cut. Measures of credit. I pay a lot of attention. I spent most of my career analyzing basically the credit markets. And you're just not seeing any sort of real problem spots in any part of what I call the leverage credit trifecta, which are effectively high yield leverage loans and now private credit, which is just a burgeoning market that's growing like crazy. And even if you remember during the days of, I think it was early August when we had that scare on the yen carry trade unwind, I faded that move. I was on vacation in Hawaii at the time, and I remember fading that move and buying, SVIX, because I thought, I'm looking at all of these credit aggregates, and they're totally well behaved. And this seemed like a very technical ball blowout. And then the other thing I think that is very important in that pusillanimous Powell piece on August 31st was that I pointed out that there was a whole confluence of supply inelasticities, some artificial, some real, that are, I don't see many people mentioning those, and I've mentioned them a couple of times before. But it's a conflict. It's not just one one inelasticity. It's several, right? The first one is oil, and you could say that one's probably the most artificial of them all because it's been supported by Saudi Arabia's unilateral cuts. But then we also have geopolitically driven inelasticity in freight rates. That's ameliorated somewhat. You've got also geopolitically driven inelasticity in certain manufacturing segments because of the whole nearshoring boom. We've got this inelasticity in longer dated coupon bonds orchestrated by yellow-bellied Yellen. And then you've got this structural undersupply in housing. And then also a demographic undersupply in certain parts of the labor pool. So when you tie all of these things together, and I've always been a big fan of saying that the sort of supply inelasticity cuts both ways. And when you have a inelastic supply curve that's getting more and more vertical, if you then enact policies that are essentially right shifting the aggregate demand curve, which pusillanimous Powell did, and did rather aggressively, then you are going to get a resurgence in inflation. And I think we're about to see that. We haven't seen huge blowouts in inflation numbers, but you've seen all the various core CPI metrics basically staying very elevated for quite some time. You've seen 5-year inflation swaps blow out. There have been a number of takes post, on the de-inversion and the bear steepening that happened after the 50 basis point move in September. It's touting all sorts of reasons, saying that, it's Trump, it's this, it's that. But, I just find it kind of, it's too much of a tell that the trough in rates came on the day that the Fed made the pivot. And then also the other big tell was the 5-year inflation swaps blew way out pretty much on that day. And also, so the last thing I'll mention about that pusillanimous Powell piece is that I had done a kind of a deep dive on the yield curve in that 1981 period, where I did like a month-to-month analysis of that yield curve and basically, analyzed what happened when Volcker similarly cut aggressively before the inflation fight was over. There, you could argue that he had a legitimate reason to do so because, with 19% Fed funds, he did put the economy into a recession. And so you could argue that legitimately his dual mandates were in conflict. But in that case, you saw that the inflation fight was far from over and the bond market took over his job. Here, even though we don't have the absolutely high levels of inflation or Fed funds rate, it's a smaller version of the same thing. The difference is that, as I argued in my piece, his dual mandates just have not been in conflict. They're still not in conflict, in my opinion. So I think, so I think that the chickens are going to come home to roost here.
Yeah, it definitely seems that way. This is a very simple question, but like, why do you think they cut 50? You mentioned Bold Bowman, who was the only dissenter at that time, and she's starting to feel like to be proven pretty correct at this stage. But like, what did they get? Like, why did they cut 50? You think?
I'm still puzzled by that, to be honest, especially with the follow-up 25 afterwards. I'm also a little bit puzzled by why Bowman dissented, and then she didn't dissent in this last one. She kind of made an excuse that she said that, okay, she's pleased with the language where they left, the door open, the optionality to pause. So, and by the way, I'm proud of this alliteration. I went from pusillanimous Powell's premature pivot to now pusillanimous Powell's potential pause. So that's going to be an interesting dynamic, by the way, because I also wrote subsequent to that piece in August that just watch. He, first of all, by cutting so aggressively, he has green-lighted a global competitive cutting cycle. And initially, if you remember, the dollar took a big hit, and I actually faded that move too. I increased my USD CNH position when it dropped to like 699, because I said that, look, the fact that Powell cut so aggressively didn't change the fact that the U.S. economy is still the strongest in the world. It didn't change the fact that the rest of the other central banks, it doesn't behoove them to have stronger local currencies. So if anything, at minimum, they're going to basically follow Powell's pace. And at maximum, they're going to have to still outdove the Fed. And you saw that happen. You saw central bank after central bank basically follow Powell's lead, right? But here's the issue. Again, because we have this unevenness in transmission of monetary policy, and unevenness, more importantly, in the amount of fiscal Red Bull that we're pouring onto the economy, I think the time is coming very soon where Powell is going to be stymied. It might even come as early as December. I think there's a decent chance that they're going to pause in December because of hot inflation data. And if that happens, that is going to, and I've written about this many times, this global competitive cutting cycle is going to wind up turning into the global bait and switch. And I think you're seeing that manifested in the US dollar just spiking. You see DXY breaching 107 today. Like, one thing I've been saying is that I think, this twin wrecking ball of a strong dollar and still relatively high oil prices, even though oil prices have come down from the highs, $20 from the $70 to $90 range. I think that oil prices are still too high because this twin wrecking ball dynamic of relatively high oil prices and high dollar is going to wreck demand, especially in the emerging markets, and especially in a place like China, which is already falling apart.
Something, Michael, I've been trying to figure out is what has actually driven this resurgence in the economy in the last few months. Because obviously, as you mentioned, the 50 bips cut came, and that was basically the bottom tick in yields, and that they've just been surging ever since. But, I'm trying to figure out whether that data in August was just the outlier where it was just deceptively soft, and now we're just back to this return to norm. So, how much of this resurgence in the U.S. economy has been due to the Fed cutting 50 bips versus how much is that was just the track we were on, and the Fed just got caught off guard by some outlier data in the late summers? What do you think?
Well, as I made the case in that August piece, I don't think I do think that we had an outlier in data, and possibly due to the large, for instance, like if you're talking about the I believe it was like we had this weak unemployment report, right? That was really the reason why Powell that was his excuse essentially, right? And he seized upon that with great gusto, and I think that was a total outlier. We've got this this huge amount of illegal immigration that's I believe clouded it. We've had a number of storms that have introduced noise into the data. But again, you can't look at one thing. You have to look at, there's so many other variables that are saying the opposite. Corporate profits.
And like credit spreads, to your point, through that whole time never blew out at all.
That's right. And the fiscal Red Bull has been continuous, absolutely continuous, because again, the three bills passed over the last several years, the Biden, the Bipartisan Infrastructure Act, the CHIPS Act, and the Inflation Reduction Act, collectively, they amount to 2.2 trillion of fiscal earmarks, right, over the next 10 years or whatever. And so that never stopped. That, and still very little of that has been actually sort of spent or monetized or whatever you want to say. To answer your question, was it the 50 that goosed it? Well, I think it's hard to actually parse out exactly what specific variable accounted for this seeming reacceleration. But I would say the forward guidance that was given, no pun intended, of course, but the forward guidance that was given in that presser was extremely significant, because you saw the market completely take the ball and run with it and do essentially, if you remember, I mean, really the beginning of the juicing happened in December. That was that I call it the December rhetorical pivot. That was the dumbest thing that he did, because that one really, if you think about it from a pure risk reward standpoint, right? He got nothing for the government in terms of any sort of interest savings, and he just goosed animal spirits unnecessarily. And then we saw this Q1 resurgence in inflation, right? And then as soon as things looked like, as soon as he got another excuse, this time he made the second worst mistake, which was this aggressive aggressive pivot with 50 basis points, front loading it, and now 75 basis points. So I think that's going to be an issue.
Yeah. Okay. So I feel like, basically the impact of everything we just talked about for the past 3 months has, the two biggest things for me has been a major rebound in the dollar, as you mentioned. We're hitting some pretty key levels here, and also just a pretty significant rebound in long bond yields. And so now I'm starting to think about, okay, if we're cutting rates into what is looking like a much more resilient economy than we thought in August, or at least what the Fed thought, at the same time that what feels like the rest of the world is not nearly as rosy, that's starting to create a situation where I'm starting to think about this idea of the dollar wrecking ball that you've talked about a few times.
Oh yeah.
So what's your perspective there? Where does this go on? What's your view on the dollar, and how does it impact the rest of global markets?
I've thought about this a great deal, and so usually what happens is that when you have these economic imbalances between countries, it's the foreign exchange mechanism that evens out those balances, right? I've always called the dollar, or the US dollar wrecking ball, ultimately it's a self-correcting phenomenon. It's a equilibration mechanism. The equilibration mechanism, it allows us to export our inflation, if you will, and import deflationary forces from without, right? But because of this dynamic where Powell essentially greenlighted this global competitive cutting cycle, to me, that was potentially the most inflationary scenario of all, where if everybody now goes into this massive easing cycle at the same time, you're just going to goose aggregate demand everywhere versus just a pure equilibration mechanism. Now, though, I think that because the U.S. is still the strongest economy, this notion that if Powell is forced to pause sooner than later, if this global competitive cutting cycle goes into what I call a global bait and switch, where Powell now has to stop or pause his cuts, but the rest of the world still needs to continue. Right? We go back to that dynamic where the U.S. dollar becomes the equilibrating mechanism. So there's so many moving pieces right now that it's a little bit hard to figure out how to position in a way, because the other thing is that in addition to my long dollar positions, I did have puts on the long end. In fact, I had TLT puts to play the long end bear steepener, but I also was short SOFR Z25 futures, because I think that the number of cuts that the market had priced in were just ridiculous and unrealistic. I've since taken off both, because with the election of Trump and this new sort of Elon and Vivek Doge thing, I think there's an interesting angle here that I actually tweeted about today, and I said that, look, even if Doge, in that speech that Elon gave at the Madison Square Garden rally, seems like eons ago now, right? Where he first talked about, Doge and how he wanted to cut 2 trillion. That was obviously a very hyperbolic claim, but I think they put out a press release yesterday how they said, their first step would be to target 500 billion in savings from a bunch of these non-congressionally mandated, government expenditures and whatnot. Well, that in and of itself doesn't necessarily do that much to that would be significant, but I think if you combine something like that with now that there's been a red sweep in Congress and there's the potential for a rolling back of certain of the Biden bills, especially in parts of the Inflation Reduction Act, I think when you combine some of these things and you reduce this fiscal Red Bull, right? And the other mental model I've used often is that we're in this wasteful vodka Red Bull economy where we've got this monetary depressant counteracted by this fiscal Red Bull. If you can withdraw some of that fiscal Red Bull, can we get to a place where it means that we can also withdraw some of that monetary depressant without an inflationary outcome? It remains to be seen. It's going to be a hard lift, right? But between this potential pause in December and at least the zeitgeist starting to shift a little bit with attention to reducing some of that fiscal Red Bull, I've taken off both my TLT puts and my my SOFR Z5. Just thinking about that. I've kept my long dollar positions, however, because I think that the tariff hawkishness is going to still force a China into this cornered animal status where their economy is so dependent on exports, and there have been many takes that China's already running a record trade surplus, and they don't care about exports to the U.S. necessarily because they've shunted it to the rest of the world. But this morning I retweeted a thread that someone named Trin Economics posted on tariffs, which I thought was an excellent thread. But I pointed out that even if the rest of the world is now taking the bulk of these Chinese exports, a large part of those exports are being redirected back to the U.S. You cannot escape the fact that the U.S. and the EU combined are the two largest end markets for these exports. Even if they first go to Vietnam first, or Malaysia first, or Taiwan first, and China's in this situation where for the last 40 years, this growth miracle we've seen has been predicated upon them essentially just massively overbuilding their real estate stock. They're to the point where they've, my good friend Alex Stahl has done great work on this. they now have like 90 million unoccupied housing units and another 120 million units that are in various phases of incompletion, right? So they clearly cannot go back to stimulating this GDP growth through the real estate sector. So I say that, the CCP's eye of Sauron has now turned from the real estate sector to its, I call it the runaway assembly line, where they have to keep this assembly line churning out goods at all costs, because it's the only way that they can keep their restive masses gainfully employed. And when you have a situation like that, you're going to force your end consumers, the U.S. and the EU, into increasingly protectionist measures, especially with the advent of Trump and probably Lighthizer having a significant role. So I think more and more China is going to feel the pressure to do a significant devaluation.
Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at scale.space/ecosystem and follow their journey on X at Scale Network. This episode is sponsored by Ledger. This Black Friday, Ledger is offering an incredible deal to secure your digital assets. From November 29th to December 5th, upgrade to Ledger Flex and get $70 in Bitcoin. Plus, save up to 40% on select Ledger Nano wallets and accessories. These deals are only available while supplies last, so don't wait. Visit Ledger's website at ledger.com today to take advantage of the best offers of the year and protect your assets with the global leader in digital asset security. Meet your secure, reliable institutional crypto partner, Kraken Institutional. Whether you're an asset allocator, a trading firm, or high net worth individual, Kraken Institutional unlocks the full suite of tools you and your organization need to trade and manage crypto at scale. But it's more than just powerful products. It's about enabling you to build and grow your crypto practice via deep liquidity, industry-leading security, and white glove service. Think 24/7 support from an award-winning account management team and expert guidance through your institutional crypto journey, from onboarding to product demos and more. Experience it for yourself. Visit kraken.com/institutions and get in touch today. This is not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. View legal disclosures at kraken.com/legal/disclosures. I want to ask, a lot of the context that you just characterized is there. When you compare that to where the market is currently pricing, especially in terms of long bond deals, and as you said, you took off your TLT puts. It feels like, and there's a couple other points I want to add in here too as well, but it feels like the market has maximally priced in this inflationary concern, because you just mentioned these potential disinflationary tailwinds from what could happen from Elon. A couple other ones as well is that, you mentioned earlier about just the situation with oil, we're at $69 and you see that potentially heading lower. When I look at what's going on there, when I look at the current labor market dynamic in terms of potential wage pressures, it doesn't feel to me as strong in terms of this wage pressure as it was a couple of years ago. So based on these dynamics, it almost feels like the market has max priced this inflationary concern. Would you agree with that, or do you feel like it's more balanced than that?
I'm not sure about that, because I wrote another piece, again going back to this idea of there being such a confluence of supply inelasticities. I wrote a piece a couple of months ago. I called it, and this is when the dollar took that dump right after. Actually, no, this is before the dollar really took a dump after the pivot. I called it, this was a piece dated on July 20th, and I called it, from US dollar wrecking ball to US dollar pickleball, meaning that, the dollar wrecking ball what are the paths that the dollar wrecking ball could take to get downgraded to pickleball status? So, at the time I said, okay, there are three paths. There's this overt devaluation path, a la, something like the Plaza 1985 Plaza Accords, right? But that would be, that would require the U.S. to overtly want a weaker dollar, and it also requires our uh, large allies to want a weaker dollar, which they currently, it doesn't behoove them to want that, right? It hurts them. So that I kind of nixed that. The second scenario was this premature policy pivot that I pointed back way back in July, and I said, even then that would be a mistake. But the third path, a potential golden path, is that I said, look, if they did some sort of deal with Saudi Arabia to have them help uh, essentially roll back their 3 million barrels per day of unilateral cuts, and you drop oil into the 40s or 50s. And by the way, there's some geopolitical reasons for that too, right? Because you also wind up wounding Iran and Russia simultaneously, which is why I think there's a lot of potential benefit to a situation like that. Well, could that then be the excuse that gives Powell an ability to reduce that monetary depressant? And I said, look, I think lower oil prices, because of the significance in the global economy, right? It's not just a transportation fuel, but it goes into petrochemicals. It goes into, factors of manufacturing in all parts of the economy. I think that low oil prices are a necessary but insufficient condition for a winning the inflation fight, because you still have these demographic challenges with respect to the labor pool and structural undersupply challenges with respect to housing, et cetera. The demographic challenges with respect to the labor pool, I think, are worth mentioning again, because, I've pointed out in the past that, my own theory on why we're seeing elevated labor pressure and inordinate sort of bargaining leverage on behalf of labor unions. You've seen rolling strikes over the last 2 years across industries in the U.S. Right? You don't that doesn't happen in a world of labor slack, right? That doesn't happen. That just can't happen in a world of labor slack. So what is it that we're seeing? And I think that if you look at the demographic pyramid of the U.S., what I find interesting is that the U.S., and somewhat closely followed by some of our allies in Western Europe, we had this baby boom after World War II. But then after the baby boom came somewhat of a baby bust. Like my generation, Gen X, was a much smaller birth wave than the baby boomers, right? But now my generation, Gen X, let's call it the 45 to 59 age bucket, you could argue is like the most highly tenured part of the workforce, and there's a relative trough of workers there. And I think you can see in some of the employment statistics how that particular demographic has been very, very sticky with respect to employment. At the same time, I think, and this goes into the housing issue, right? There's a structural undersupply of housing that is not easily correctable very quickly. But at the same time, if you look at that same demographic pyramid, the age cohort of 30 to 39, right, is at a huge, it's kind of like another baby boom period. And that age cohort is essentially demand inelastic when it comes to buying homes, because they're in the process of forming households. So I think you have to pay attention to some of these like longer term demographic factors. And so again, going back to oil, right? Low oil is a necessary but insufficient condition in and of itself, in terms of allowing us to really say that we've won the inflation fight, because there are all these other inelasticities that don't go away overnight.
That's an interesting dynamic because it sounds like, from your perspective, there's some secular pressures on inflation that are going to lead us higher versus like the way I've been thinking of how I was characterizing it there is that if you look at cyclical data like the JOLTS data, job openings and quits rates, it looks like it's a pretty, it's a very different labor market from before where the employee had a lot more negotiating power. But what you're saying is that these are more secular changes. And on the housing side of things, I was looking at potentially when Trump comes in and starts, doing mass deportations on immigration, that could be an exhaust valve for potential just rent supply, which would ease that potential shelter inflation.
It could ease the shelter inflation, but then it could exacerbate the labor inflation.
Yeah. So, basically like, yeah, there's maybe minor improvements from the cyclical basis, but overall there's some much bigger issues at hand, is what you're saying.
I think they're deep issues. I think some of these are structural and some of them are cyclical. Again, in that August piece, I pointed out that it's very significant that you have a confluence of like 7 or 8 of them at the same time. And so when you have that, right, when you have everything aligning like that, what you don't want to be doing is goosing the aggregate demand curve.
I want to talk a little bit about all these dynamics at play that we're talking about and how it starts to get reflected in markets. Obviously, we've talked a bit about the bond market, but we'd love to hear your perspective, maybe starting with equities at that juncture. If you look at, say, a stronger dollar, you would potentially think that would be a negative headwind for potential risk assets, but they've been doing okay. We've been seeing
Yeah.
equities in all-time high. So what's your view there in the context of everything we've talked about?
Maybe in the and this is partially just a rationalization of the price action, right? And just basically witnessing how this market has just been the Teflon market to any potential headwind. But when you see that we have these Mag 7 super mega caps that are essentially tech and cash heavy and not indebted, and they're also not exporting product, right? In the traditional sense, you begin to see why our equity market has essentially been so resilient, right? And one thing I pointed out, almost 2 years ago now, I presented this paper at West Point talking about the role of the dollar in economic warfare. But one of the points that I made there for the case of having a strong dollar policy to pressure China was that, we don't, the US amongst the G5 is the least export dependent country there is. So if there's any country that can essentially stomach a strong dollar and still be okay, even with all of these like nearshoring initiatives as well, it's going to be the U.S. So I think that's part of it. I think it used to be. I mean, the U.S. economy of several decades ago certainly was more export dependent, but we clearly are not nearly as export dependent as we were. It might
Yeah.
make I think initially, I think Trump has maybe flip-flopped on this idea now, but he at first on the campaign trail he talked about wanting a weak dollar, right? But then I think he kind of stopped talking about that because he realizes that we might need a strong dollar to pressure China, and tariffs will probably strengthen the dollar. So I think he's since sort of not talked about a weak dollar anymore. But it's also, I think, probably a realization that a weak dollar doesn't really help the U.S. that much.
Yeah, that's fair. Yeah, do you think that obviously you think that domestic equities would be okay, but I imagine in this dollar wrecking ball world, emerging markets are not nearly as rosy, and especially China. You mentioned how the stronger dollar is potentially going to be pretty much keeping a cap on China to be able to meaningfully stimulate their economy. So do you feel like that's just like a continued cap on China? What do you see there? You mentioned that obviously they need to devalue, but can they is another question, right?
The point that we made in that paper was that China has not been a friendly actor, obviously, on a number of different fronts, right? And the part of the reason why there has been a search for a dollar alternative has been, this much touted, seizure of Russian assets after their invasion of Ukraine 2.5 years ago, right? And so this has spawned all this BRICS talk and all this search for an alternative to the U.S. dollar. The point that we made in that paper was that we over the last several administrations, during Biden, during Trump, even going back to Obama, if you look at the number of financial sanctions we've imposed, they have been significant. That's the reason why you're seeing this active search for a replacement. And we made the point that, look, there are many reasons why the world chooses the dollar as reserve assets. There's so many reasons, whether it's like our rule of law, our military power, the liquidity of the dollar, the liquidity of underlying bond markets, which is a very, very significant aspect of it. So even with all of those financial sanctions, it'll be very, very difficult to dislodge the role of the dollar. But why encourage that search when we don't even have to? And our point was that if I think I liken it to financial judo, right? In the art of judo, it's a martial art where you're kind of leveraging your opponent's mass against them, right? You don't go head to head with somebody that weighs 3 times your weight. What you do is you kind of like trip them up, and you let their mass work against them and their weight work against them. So what we said was that, if you just naturally allow the dollar to be strong here, China is in a vulnerable state because they are very, very levered. Most of their debt is off balance sheet, but it's going to get increasingly consolidated onto the balance sheet because their off balance sheet financing vehicles, the LGFVs, are pretty much tapped out, right? China is, unlike the US, is short on natural resources. So we are, long in natural resources, but through various dumb policies, we have kind of shackled ourselves and handcuffed ourselves in developing some of those natural resources. And the first thing is do no harm to oneself. We need to stop with those artificial handcuffs, take off those artificial handcuffs with respect to energy development, right? And coupled with certain industrial policies like nearshoring, I think you can have an economic warfare or economic defense strategy where you don't really need to rely on so many overt sanctions. You can just let the strength of the US dollar wrecking ball do its job. And frankly, it again, going back to the US dollar wrecking ball's role as an equilibrating mechanism, it serves a dual purpose, right? It serves a purpose of dealing with our domestic inflation issue while, hamstringing a large geopolitical adversary who's underlying. If they're short dollar denominated commodities, obviously you see where the vulnerability comes.
Just as we begin to wrap up here and circle back, I just want to start to look a little bit more towards the future here in the rest of the year. Obviously, there's the Fed meeting in December, and as you mentioned earlier, the odds of whether they cut or not are somewhat split. I just looked at the forwards right now, and it's looking like 55% chance cut, 45% pause. So it's up in the air, and I'm just curious, like, how do you think markets react depending on what happens here? So let's say Powell pauses. Do you see long bonds rally? And on the same vein, if they cut, do you see the long bond getting unruly in that juncture, or do you feel like it would just keep it elevated?
I feel like if he paused, that I think there have been a number of markets that have priced in this very, very aggressive easing cycle. But it's also, I'll caveat that with saying that, the bond market, the longer part of the yield curve has indeed done some of the Fed's work for it and kind of compensated, right? But you're not seeing that manifest yet in equity prices, because you would expect, right? One would expect that the import of the 10-year risk-free rate to have a much bigger impact as a discounting mechanism on long-lived asset prices like equities and
And
home
like in the
prices.
last couple of years, the last two times the bond yields have been at this juncture, that's what happened. Equities did puke, but they haven't this time.
They haven't this time, and so it's a very perplexing market. For the first time in a couple of weeks now, I actually, aside from my long dollar, my US dollar CNH positions, I don't really have any macro positions. Most of my bread is buttered, chasing idiosyncratic alpha. Actually, we don't really talk about that. I talk about macro so much on these podcasts. I don't really talk about idiosyncratic stuff, but my portfolio doesn't care about what the Fed does, hopefully.
Yeah. Yeah. I remember you mentioned that, you followed pretty closely like a Merton model in terms of just like different capital structure arbs, right? Something like that.
That was talking about something different. That was talking about how, that Merton model piece you're referencing was really talking about how, equities are essentially long call options on firm assets, whereas credit should be viewed as short put options on firm assets. So that's like a holistic view of how I look at the capital structure, and yeah.
Cool. Just as we wrap up here, any other major forecasts in terms of, we didn't talk too much about the other commodity markets or anything like that, or anything in terms of other currencies aside from China and the US, but any final thoughts there?
Again, I think pro-cyclical commodities are still flashing kind of a cautionary sign, I would say. And, so look at copper, right? Copper has weakened quite dramatically, and I think that is directly related to China. I think you got to watch oil. Oil is the big thing. I've been saying for quite some time now that I think, when Trump attended that UFC fight recently, you saw that he was sitting next to the manager of like the big Saudi sovereign wealth fund, and I put out a tweet and I said, what I'm imagining Trump whispering to him right now is, hey, listen, if you help me out with getting oil prices down, I'm going to make it worth your while. And I really think that that's an elevated risk with Trump being the deal maker that he is. I lived through a very, very painful period in the oil patch in Q4 2018, which I labeled the Trump rug pull. If you remember what happened there, he basically took us out of that. That was right when he took us out of JCPOA. And the oil markets, after a multi-year bear market, were finally starting to strengthen based on tightening supply dynamics due to potential lost Iranian supply. And Trump basically calls up his buddy MBS and says, hey, look, I need you to help me out here, and essentially flood the market and make up for that lost Iranian supply. And he promised very, very publicly that there would be no waivers to Iranian sanctioned Iranian oil. Well, MBS floods the market, and on the, I think it was at the end of October of 2018, Trump grants 11 waivers, and then the oil market just absolutely collapsed. Now, you could ask the question, well, why, you burned me once, why would I fall for that again? Why would MBS fall for that again? Well, the difference is that you have to understand the dynamic here. OPEC plus, and I've also written about this at length since they began these unilateral cuts about almost 2 years ago now. They painted themselves in a corner. Saudi Arabia is capable of producing up to 12 million barrels per day. They're currently producing 9 million barrels per day. It's a large amount of spare capacity, and they have unilaterally borne that because Russia and Iran and the UAE have basically been cheating. U.S. shale has also been, producing like gangbusters. It's not going to last forever, but right now it's well over 13 and a half million barrels per day, right? So they now find themselves in this situation where the biggest their biggest customer, China, is having serious economic problems that appear to be secular in nature and not just cyclical. And they have no exit strategy. So the question is, right, can Trump make it worth their while if he offers them some sort of security guarantee or nuclear umbrella or something, right? That basic and making it a point to Saudi Arabia that, hey, look, remember that your revenues equal price times volume, and you're the only large producer that can make up for lost price and increased volume. But at the same time, if you give me this win on domestic inflation and give me this win in terms of more negotiating leverage against a economically weakened Iran and Russia, it makes too much sense for me to think that those conversations are not going to happen. So I think I think oil is a key commodity that I'm watching.
Yeah, totally. I feel like that really just paints a theme that like the next 4 years are going to be very headline heavy, very macro trading heavy. It's going to be a fun time.
Fun, but also tricky, right? Because because the other thing, I'll just end with this. The other thing is that the world, there's so many asset classes, whether it's like oil or gold, that have, or defense stocks that have basically priced in sort of a world of eternal conflict. And if you think about what Trump's platform is, it is to not embroil ourselves in forever wars. And so if we have, I said something last week, I said, what if the unthinkable happens and there's a breakout of peace, right? And that's ironically a treacherous path for a number of assets that have priced in the opposite. So that's
like gold, or for example, or
gold. I think there's a lot of geopolitical premium that have been built. That's probably been built into gold, oil, even treasuries.
Yeah.
There's a lot that's, I feel like, changing in the world right now. So it's going to be very interesting, but also tricky.
Agreed. Well, look, Michael, it's great to have you on finally. Where can folks go if they want to hear more about your writings and your musings?
Urban Cowboy, KAO, urbancowboy.com. That's my Substack. And then same handle on Twitter. Appreciate you having me.
Awesome. Yeah. Thanks, Michael. That was great.
Awesome. Thank you.
Looking for a blockchain that combines high performance with zero headaches? Scale is your answer. With its advanced parallel processing and modular sharding, Scale delivers gas-free transactions and limitless scalability, perfect for gaming, AI, and consumer-facing dApps. Already a top 10 blockchain on dApp radar, Scale is powering next-gen use cases with over 750 million transactions and counting. Discover the future of Web3 at skale.space/ecosystem and stay up to date with their journey on X at Scale Network.